Ladies and gentlemen, I hope you had a fantastic freaking weekend and you are ready to go and you are pumped up because this week is full of potential volatility, and that volatility could be to the upside or to the downside in a huge way. So we specifically have a breakdown of the summary of economic projections. Some of you guys did not like how bearish the last video sounded, and to be quite honest, I'm not very bullish for this week. For the short term in the markets, it's hard to be pretty bullish when stocks are trading at near all-time highs. The S&P is 3% off of all-time highs, when it looks like the economy is decelerating into what could be a recession, and the S&P probably not going to be great. But we are going to go over two scenarios, a good one and a bad one, and I hope you find a lot of valuable insight here in this video. If you want to come take it a step further, come trade with us, come hedge your portfolio, link down below in the description of this video for the trading community. But that is neither here or there. We have Tesla stock news to get into before we go over this week and the summary of economic projections. But first, before all of that, hit that like button if you are an investor in Tesla stock. That is the first thing you should be doing as you click on this video, because every time you click on the video, you should be able to look and see how many other Tesla stock investors have watched it by the like button and the count of likes. The first thing that we need to talk about, and I think this is massive, Mr. Beast just put out a video. I believe it's 100,000 or $1 car to, okay, so that sounds pretty bad that I didn't even know the title of the video. A $1 car versus a $100 million car. The $100,000 car is a Tesla Model X with, you guessed it, full self-driving. And we're going to go ahead and play this little part of this video where they kind of talk about it, okay? And I this should be very bullish, and we'll talk about why here in just a second.
The real reason you're buying a Tesla is because it can drive itself. All right, I'm no longer driving the car. Oh, it's switching lanes. Whoa! It is literally driving itself. My feet are not touching the gas and I'm not touching the steering wheel.
Jimmy, are you telling me now you can take a nap while driving?
No, don't do that.
Oh, okay.
Now, let's see how fast the car can go.
It jerks you backwards.
Mr. Beast on averages 150 million views a video. And the Tesla Model X was featured 1 minute in. 1 minute, 3 seconds to be specific. So you're capturing the most amount of those potential 150 million viewers. Now, if this video does really well, some of Mr. Beast's best videos have gotten 300 to 500 million views. 150 million's great, 100 million's great, 50 million's great. The potential of this video and the free advertisement FSD just got should not be underscored at all here. You should be very excited. A lot of people don't even know FSD exists. I live in Michigan. I talk to people all the time that have no idea cars can drive themselves. And look at that, just as I expected. On the Google Trends data, FSD in lowercase, full self-driving, and FSD in capital letters are all spiking. And this is at a time where this video from Mr. Beast has only reached 34 million viewers. Check where it is today. Check what the Google Trends are. I'm sure you continue to see a spike in Google Trends. Now, I don't know if this was a paid promotion. It's possible Tesla did make this a kind of advertisement paid promotion. If they did, that's freaking genius. Genius on Tesla's part. Good job, Elon. If they did not, well, that just shows Tesla as a product is off the chain if it's going in a Mr. Beast video. Now, if the conversion rate from anyone watching this video is even 0.01%, you're talking about thousands of sales of full self-driving that can have a impact on Tesla's earnings, Tesla's bottom line. And to specifically highlight full self-driving, such a high margin product, I'm blown away. This is fantastic news for all Tesla shareholders. We also got some news from Tesla over the past couple of hours that Tesla has officially produced its 5 millionth car. This is just 6 months after they produced their 4th million car. The Tesla ramp is getting into full steam ahead. Let me know how many months you think it will take for Tesla to produce its 6th million vehicle. I'm gonna give it around 5 months. Maybe 4.5 months. Tesla has now invited customers for a test drive at its first experience center in Thailand for the first time ever. This is pretty cool given Tesla just recently started to expand operations in Thailand and hopefully can grow an even larger footprint. And just look at Tesla's building here. It's absolutely beautiful. Kind of looks like the entrance to an airport. UBS has raised their Tesla price target to $290 from $270. They believe Tesla's pricing strategy could potentially provide it with a formidable competitive advantage, allowing the company to expand its customer base. This approach may also create challenges for competitors grappling with higher operating costs. Stellantis has offered raises, inflation protection measures to UAW as the strikes continue. Stellantis' latest offer to UAW members will include pay raises of nearly 21%, including an immediate 10% increase. Ford and GM have also resumed negotiations with the UAW. Now, the problem here, the way I see it, is that since 2019, the compounded rate of inflation in that 4-year period has been 19.5%. And they're basically at these offers just getting back what the last 4 years they have lost in purchasing power. What the union wants is something that is more forward-looking, that's going to price in more inflation over the next 4 years. Now, obviously, you start high, and the UAW wants 40% pay raises, and I think that is actually doable from Ford, GM, and Stellantis. I think they could, in theory, agree to that and not go bankrupt. The problem is, the UAW wants full pensions back, which they don't get full pensions anymore. It's not like it was in the 70s, 80s, and 90s, right? That's thousands of dollars even after you retire every month for everyone. That's unsustainable. You cannot do that, especially over the next coming years, as you're going to have to spend billions, tens of billions of dollars just to try and compete with Tesla. That's the number one problem. But number two, 32-hour work weeks to receive these pensions, your productivity per worker just dropped dramatically, and in theory, you may need to hire almost 10% more workers, or 25% more workers, to fill that 8-hour gap of productivity you are losing. That is, just unsustainable. You can't do that. So I think that's where the real problem will be, and I think that's potentially why these strikes could last a lot longer than what a lot of people are expecting. And if you just look at the share price of Stellantis, Ford, and GM on Friday, they actually did pretty dang well. Stellantis was up almost 2%. You would have not expected that. And I think that's because markets are sitting here and saying, hey, this is a temporary shutdown. It will help these companies cut cost for this quarter and maybe even next quarter. And we're just going to get better profit numbers. Margins maybe increase. If this strike lasts a long time, Ford, GM, and Stellantis share price itself is in deep, deep trouble. And this could actually be a big negative factor to the markets. And that's what I would like to highlight as well. GM's CEO said on Friday, for every one GM job, there is 6 other jobs that count on that job. That one GM job. That is dealerships, that is part suppliers, that is detailers, that is people that just do maintenance on GM vehicles, 6 other workers. So if this strike does really take hold and potentially all UAW factories, you're going to be looking at a massive problem for the entire economy of the US. And that is something I am not very optimistic about. Let's be honest. This was a huge deal in 2019, and give it some time, and this is going to turn into a very bad event for the economy. This could be the tipping point for the economy. The economy has not been doing well before the strikes, and you can see that in all of the data we share in every video. The economy is not doing well. Ken Griffin just said we're very quickly heading into recession. The personal savings rate is 3.5%. Car delinquency rates are at higher levels now than they were during the peak of the global financial crisis when unemployment was 10%. If that unemployment rate starts to rise, in which it has recently from 3.4% now to 3.8%, if you start to break above 4%, head to 4.5% or even 5%, you're going to be in a whole world of trouble for the economy. That's how close we are to walking over the edge. And if these strikes are not resolved, that's going to be a problem. If these strikes get resolved soon, I will become a lot more constructive and incrementally positive on the markets. Until that happens, it's hard to be positive given everything that is going on right now. Just inflation has eaten away at your purchasing power. It's ridiculous how much things cost now compared to where they were. A dang taco went from $3 during the Rona or 2019. Today it's $6, $7. How do you even feed your family? That's a real question I have. People just can't save money. You can't save money. You've gotten, what, a $2 raise in the last couple of years? $3, $4 raise? Doesn't even make a dent. Okay, I'm just starting to rant now, but as you can see, it's kind of frustrating. So I understand why you guys are so frustrated as well. Now let's break down the summary of economic projections and what you really need to be watching for. Now the Fed meets on Wednesday. That's going to be really the big data that we get for this week, and that is Wednesday at 2 p.m. Eastern Standard Time. You're going to get the summary of economic projections, which is like Fed Waller, Fed Bostic, Fed Bowman, Fed Cook, Fed Mary Daly, all your Fed regional presidents and Fed Jerome Powell coming together and putting their dots on a plot on where they expect the economy to be, inflation to be, unemployment to be, all of that. So it gives you a inside projection on what the Fed is thinking. That's why it's so important. And then at 2:30 p.m., you get the Fed press conference. But then really throughout the rest of the week, you don't really have anything too crazy that will move the markets. That is basically your one big event for this week. Now, the summary of economic projections. Basically what we have seen in 2023 was the Fed was pretty negative during March. Looking ahead for 2023, the Fed expected 0.4% GDP, pretty close to going negative, pretty close to recessionary. In June, the Fed expects 1% GDP for 2023. Let me tell you right now, none of this column right here, all of these numbers matter coming on Wednesday. Unless there is a huge change, unless the Fed funds rate, which you can see right here, which in June, the Fed expected 5.6% Fed funds rates by the end of 2023, which, opened the door for 2 Fed rate hikes, and that's ultimately what we ended up getting. Well, that freaked the markets out a little bit. But unless we get like 4.5% Fed funds rates as the estimate for the rest of this year, or even 5%, well, that's where the markets might freak out and say, hey, what the hell is going to happen in the next essentially 3 months to get rates to fall 2 times or get 2 rate cuts? In other words, I don't expect much change for the 2023 numbers. Who even cares? It does not matter. 2024 is what the markets are going to pay attention to. Now, the last estimates from the Fed had the real GDP for 2024 at 1.1%. What's actually interesting is during June, the Fed raised the projections for the 2023 GDP, and they actually lowered estimates for 2024 GDP from 1.2% in March to 1.1% for the expectation in June. Now, I expect this number could come down by quite a bit. You could be closer to 0% expected GDP for 2024. Now, if the Fed just lowers it a little bit, maybe to 1% or 0.9%, markets might be okay with that. 2025 doesn't matter as much just because the markets are forward looking, but they're not 2 year out forward looking, right? Or over a year. Markets don't care all too much about 2025 right now. Now, for the unemployment rate, this is where things get tricky as well. The Fed already expects 4.5% unemployment for 2024. Odds are, if they're expecting lower GDP, they're going to expect higher unemployment. And at 4.5%, you're already basically saying we could be borderline recession based on the historical kind of performance of unemployment. If unemployment goes up 0.5% in a short amount of time, that's always led to a recession. You just jump from 0.4% to 0.8%. That is 0.4%. In theory, if unemployment just goes up one more tenth to 3.9%, especially if it breaks over 4%, you're basically guaranteed going to head into a recession, as far as what history can tell us as a guide. Now, inflation projections. This is something that could either really make the markets excited. Inflation projections as well as the Fed funds rate. Now, if inflation projections come down, that's going to be pretty bullish for the markets. Now, you have to take into consideration the GDP and the unemployment rate expectations. And this would really be your best case scenario, is if PC inflation projections went down, even just by a little bit, and your unemployment rate expectations went down, and your GDP expectations stayed the same or went slightly higher. That's your best possible outcome. Not the most likely outcome in my personal opinion, but that's the best potential outcome. Now, in March, the Fed expected the Fed funds rate by the end of 2024, keep in mind, this is by the end of 2024, to be 4.3%. Well, in June, they revised that to 4.6%. Now, if the Fed has on their dot plot, the Fed members expect Fed funds rates to be 4%, that would probably be pretty bullish for the markets. Just because inflation's fallen a lot, even, since where it was before. If you look at just inflation as a whole, you've basically conquered inflation at this point. Yeah, food, energy, shelter, those things are going to be a little bit more volatile until we do head into a recession or big slowdown out there in the economy. So if that does come down, maybe not quite to 4%, but like 4.3%, or come down a little bit at least, the markets might say, hey, that's good. That's great. We like that. But if you see the projected federal funds rate either in 2024 or 2025, I think this is more applicable to kind of 2025 as well, as far as causing a market move. If you come down to in the threes, if you come down to like 3.5%, markets will not like that. Because they're going to sit here and say, why would the Fed need to cut rates 4 times in 2024? Well, 6 times in 2024. If the target range was 4% by the end of 2024, and rates today are around 5.5%, that would be 6 rate cuts in 2024. That would be telling the markets that maybe something is not okay here. Now, the problem is the markets are not at lows. The markets are 3% off of new all-time highs. This would be very different as far as actually sitting here and trying to predict what the markets are going to do. That's obviously a fool's game, and, hedge if you want to. I'm personally hedging, but I'm not going to sit here and say that I know exactly what the Fed is going to say or what the markets are going to do. But I'm sitting here and saying the odds that the federal funds rate projections fall, the odds that inflation expectations fall, which is great, are high, but the unemployment rate either stays the same or goes higher, but really your GDP expectations probably come down quite a bit for 2024, aka pretty recessionary. Odds are the markets are not going to like that, trading at close to all-time highs, 3% off all-time highs. So that could give you some give back in the markets. Now, again, just to clarify, your best case scenario, which I do think is possible, it's unlikely, and I'll talk about here in just a second what I expect out of the summary of economic projections, but your best case scenario is if GDP stays the same or even moves higher a little bit for 2024, your unemployment rate stays the same or moves lower, your inflation targets stay the same or move lower, or your federal funds rate comes down a little bit. That would be like the best case scenario. Higher growth in the economy, lower interest rates from the Fed, lower unemployment, and lower inflation. That's your best possible outcome. But your worst possible outcome is if federal funds rate projections head to about 3.5%. Again, Fed dropping rates, you might think that's great, but why are they dropping rates? The markets would panic today if the projection was 3.5% Fed funds rates in 2024, because last we knew in June, the Fed was expecting 4.6%. So what happened from June until September that now makes the Fed think they're going to have to cut rates, 6 times more or 4 times more than what they thought in June? So keep that in mind. And your worst case scenario would be inflation, PCE, expected to stay the same, your GDP estimates to come down, and your unemployment rate to stay the same or go higher. Hopefully this makes some sense. You might have to watch this part a couple of times to fully digest what I'm saying here, because it's a lot of numbers. It's a lot of on the brain, like they say in The Wolf of Wall Street. But that's kind of your best and worst possible outcome. Now, my expectation, somewhat in the middle of all of this. I don't expect a doom and gloom situation, but I'm not expecting the markets to like it at all-time highs. So my expectation is the federal funds rate is probably going to be estimated to drop to about 4.1%. Mark my words on this. I could be wrong, it could be right. These are my estimates. Fed funds rate projection will drop to 4.1%, which in March your projection was 4.3%. The only difference is we've raised rates since March. So that's the big difference here. So it'd be slightly lower than your March projection. I expect inflation expectations might actually come down a little bit to like 2.3% across the board for core and headline. I expect your unemployment rate could move back up a little bit. March, the Fed was expecting 4.6%. I expect that could reach 4.7%. And your GDP expectations, I expect that is going to come down by quite a bit. Going to come down to probably 0.3%. Now, again, I would like to reiterate that Tesla is either going to fall or go higher over the next 2 weeks, 3 weeks, based on what happens in the markets. I am not bearish on Tesla in the slightest sense. A lot of people get that confused. I'm not bearish on Tesla at all. I'm bearish on the markets. I think Tesla is significantly undervalued. I think there's a lot of reasons to own Tesla. The Cybertruck, the Highland Model 3, even look at the Mr. Beast full self-driving promotion a minute into a video that gets hundreds of millions of views. These are all very bullish things, positive things for Tesla. I would not bet against Tesla when the estimates on Wall Street are 29% EPS growth and 27% delivery growth, when Tesla has been at 50% delivery growth for multiple years in a row now. I would not bet on that. And Tesla is breaking into a new, completely different segment that they've never been in before, which is trucks. You're crazy to bet against Tesla heading into 2024. And that just shows how delusional Wall Street is. Tesla is by far the most shorted stock in the markets, with over $23 billion worth of short positions. Apple, Nvidia, Google, Amazon, Microsoft, they're less than half of $23 billion. They're around 10 to 12 billion short. And they are 3 to 5 times larger than Tesla today on a market cap basis. So again, I'm not bearish on Tesla in the slightest sense. I'm kind of bearish on the markets over the next couple of weeks. Now, what's actually interesting is Tesla has a lot of positive things going on a technical basis at a time where the markets could be very volatile and could come down, in my opinion. You have this downtrending line. You're now above that, holding strong support. Great sign for a move higher. You do have an RSI that's at 61.65, a little bit elevated, but not skyrocketing. It's really in a healthy range, I would describe it. The MACD that went positive back here on August 28th, and by positive, I mean the yellow line broke above the blue line. That is showing positive short-term trend. Well, you just went actually positive on the MACD recently, and the MACD is at 3.64. Your average, basically on Tesla, anytime the MACD goes negative, your average kind of comeback is around 17 on the MACD. Tesla's at 3.6 today. Tesla stock would have to go to the low to mid 300s to get back to a 17 on the MACD. So anything close to that, I mean, just the low 300s would be a substantial rally from here. So there's a lot of reasons to be pretty dang bullish on Tesla, but not so much on the broader markets. So let me know what you think about all of this information down below in the comment section. I do apologize for rambling a little bit. We did take quite a while on this. I wanted to go through an in-depth kind of breakdown on my expectations for the summary of economic projections, a good and a bad possible outcome for this Wednesday. This is the biggest thing the markets are going to react to, and it wouldn't surprise me if Monday or Tuesday are red heading into the summary of economic projections. That makes your odds of a rally after the summary of economic projections on Wednesday a lot better if stocks sell off heading into it. If stocks rally into the summary of economic projections, well, that could set up for a very nice short-term hedging opportunity to essentially make a lot of money. So that is going to do it for this video. Hit the like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. If you guys want to come trade with me live in real time, link down below in the description of this video. My name is Michael Tyler. Enjoy the rest of your day, and I will see you in the next one.